Chapter 1 deals with accounting in business, and first it explains the importance of accounting. So basically what an accountant does is sits down and looks at transactions to say, okay, what transactions do I need to record? And then how do I actually input those into our general ledger and then prepare reports to communicate to management and to external users such as creditors and lenders and people like that. So accounting basically is the information and measurement system that identifies, records, and communicates all of the business activities. So who uses that accounting information? External users, so people who are going to invest in the company, people who are going to lend money to the company, so banks and could be investors also. The external auditors who are going to come in and verify that these numbers are accurate so that this company can actually be out and selling stock and selling bonds. And then regulators like IRS or different business industries that will have different regulators. Internally, there's managers that are going to use this data to make better decisions and to be more efficient. So purchasing managers, HR managers, production managers, marketing managers, almost anybody. I mean, then the CFO, the president, everyone's kind of analyzing these numbers to see how the company is doing. So if you are thinking, well, hey, should I major in accounting? You can see there's various fields or focuses in accounting. So you could go financial, which would be working at like a CPA firm and analyzing these publicly traded companies, whether you're auditing them or maybe doing some bookkeeping services for them, but you're doing something to help businesses. And again, more outside. Managerial means you actually work within that business. So maybe you got a job at the Timken company and you work in accounts receivable or accounts payable, or you're an accounting supervisor or a manager. That would be a managerial accounting job. Taxation is more external as well. I mean, you can have internal tax accountants, but then all they're dealing with is the various taxes that the business needs to pay. Many times it's externally, you'd work at a CPA office, but your focus would be preparing tax returns. Then we come over here and there's a lot of accounting related jobs. So you can see some of them are in banks, some of them are in finance organizations. There's FBI investigators for forensic accounting. So there's a variety of different fields that you could get into if you wanted to be an accountant. AI or artificial intelligence is kind of the newest buzzword in accounting, as well as data analytics. So artificial intelligence can happen for very redundant tasks that we could set up like a computer program that it will automatically do some of these things. So it takes a lot of the redundancy away from people, the accountants, so then the accountants can do more of the analytical things. Data analytics is like using Excel or Power BI or Tableau and taking this data and creating something meaningful out of it, preparing reports, looking for inconsistencies, creating graphs that you can share with your, again, management or stockholders or whoever has an interest. Accounting and ethics go hand in hand. So obviously ethics is a high topic for accounting, but ethics is basically what is right, what governs right and wrong behavior. So from a business standpoint, a lot of times that can be even more complex than just in your personal life. So you've got to identify what are ethical concerns and then consider the consequences to various actions, like in what would be your best. A lot of times in accounting, we also have to factor in like cost benefit analysis, because sometimes maybe your option that seems like it would be the best is going to be very cost prohibitive. So that factors into analyzing those options. And then you've got to make the best decision for the company. The fraud triangle, again, because in accounting, there is an opportunity if you've got the ability to access funds or cash or move money, or even just accounting fraud. So you could create financial sales and have higher net income and get more investors. So even though you're not stealing money, you're making the financial statements inflated so that you can get people to invest in your company. So all of those are the kind of accounting frauds that could happen. So in order for those to happen, though, we talk about this fraud triangle. There has to be the opportunity to do it. So the person sees a way that they could either steal money or that they could prepare some fake entries and get them into the system. And then there would be some sort of pressure to do so. So if you're stealing money, maybe you're going through bankruptcy, maybe you're going through a divorce, maybe you have a gambling debt to pay. So there could be there's some sort of pressure thinking I need this money. If it's the financial, like making the fake financial entries, the pressure is maybe your stockholders are saying, hey, I thought you guys were going to do good this year. I thought that you'd have a higher net profit. Like you've made promises to these stockholders and you want to keep those promises. Rationalization is, well, like if you're the employee and you're stealing money, well, they didn't give me a raise last year and they're doing good and I didn't get a bonus, or so-and-so makes more than me. So somehow you make it okay in your mind. From a accounting fraud standpoint, many times it's, well, if I'm going to inflate sales this year, I'll catch up next year and no one will ever know. I mean, I'm just going to throw some revenues in this year and I'll wash them out next year. So you come up with a way to make it okay. It's still not okay, but people rationalize it. Throughout this textbook and this course, we're going to talk about generally accepted accounting principles. We'll call those GAAP, and we'll abbreviate them GAAP. But basically, those are the information that that we go back to, the rules and the concepts to say, how do we properly record these transactions? And if everybody follows GAAP, it makes information very relevant that you can compare from one company to the next, and that it accurately reflects the business's transactions. The Financial Accounting Standards Board, FASB, they are the ones who actually set generally accepted accounting principles, and their authority is given to them by the Securities and Exchange Commission. And the Securities and Exchange Commission governs all publicly traded companies that are selling stocks and bonds in the stock market. International Accounting Standards Boards, as we become more and more global in our operations, it's important to know that our generally accepted accounting principles go hand in hand with these international accounting standards so that there really is no major discrepancies. Normally, the international accounting standards are a little bit broader, and we get into a little bit more detail in our GAAP. So the major accounting principles that we have are the measurement principle, which is our cost principle, which says we are going to record everything at cost, what we actually pay for the product or the asset or whatever we're purchasing, or if we are assuming a liability, what is the value of that? Our revenue and our expense recognition are saying that we are going to recognize revenue when we've earned it, when we've provided the goods or the service to the individual or the company, and we know the amount that we're going to charge them, we should record that revenue. The expense says we're trying to match the expense to the revenue that created it. So if we had costs that we used up while we were producing those revenues, those should go in the same period as the revenue does. The full disclosure means a publicly traded company, normally they prepare a large annual report at the end of the year that discloses any relevant information that is needed to properly understand those financial statements. Accounting assumptions are that they're a going concern, that the business is presumed to be in continuing operations, like not going out of business anytime soon. The monetary unit assumption that it's all of the stuff we're going to do is going to be in United States dollars. But again, if we were international, maybe it'd be in euros, but there's some sort of money unit assigned to it. The time period for accounting, we normally do monthly statements, quarterly statements, and annual statements. And the business entity assumption is that the business would be separate from any of their owners. As a publicly traded company or an incorporated company, they have a separate legal existence and would prepare their own tax returns and enter into contracts in their own name and all of that. Some constraints in accounting is the cost benefit analysis. So like I mentioned that with ethical decisions, we always have to make an informed decision looking at cost compared to benefit and choose the one that has benefits that outweigh the costs. I mean, at least as much as we possibly can. A materiality constraint is that we don't need to disclose every minor detail that happens in a business. Obviously, there could be millions of details. So we have to look at it from what would impact a decision of a reasonable investor or a reasonable user. If we think that would impact their decision, then it would become material, then we should disclose it. Conservatism and industry practices, those we always have to live within, and normally we want to be that conservative investor because as a corporation you are really working with other people's money, so you can't necessarily take any undue risks, or you shouldn't. Then we have our different forms of business. Again, there's sole proprietorships that are self-employed people, partnerships where it's multiple self-employed people coming together to work together and share costs. A corporation is what primarily we will be talking about in this book, is a company that is publicly traded. They're selling stock or bonds out in the market, and they have shareholders and a board of directors that govern them. A limited liability company is kind of a newer thing that especially small businesses are doing because it has the benefits of a partnership and then the benefits of a corporation. So then now getting into our accounting, the accounting equation. So it's the assets equal liabilities plus owner's equity. And really that is something that you want to kind of commit to memory and understand. Where it can get a little bit more detailed is as we get into this expanded accounting equation. The assets and the liabilities are fairly straightforward. Assets are things that we own. Liabilities are things that we owe or debt that we owe. The equity is where, again, it gets a little bit more tricky. So in the equity, we have our common stock, which is if we have stockholders, what have they contributed into the company in return for shares of common stock? We may have paid those stockholders dividends, which are going to get subtracted out of this retained earnings. That's part of our equity. And then revenues less expenses. Our net income closes into those retained earnings. So then that can be a lot of different accounts, but as you incur expenses, it reduces your net income. And as you earn revenues, it increases your net income, and then net income goes into retained earnings, which is part of equity. So then we go through some different transactions just to identify what's involved. So Taylor invests $30,000 cash in a company in exchange for common stock. So we have cash coming in and common stock going out. Then here it would go into our accounting equation. Again, cash is an asset, common stock is an equity. So our equation balances our assets equal our equity. Then we purchase supplies for cash. So again, supplies is an asset and cash is an asset. Supplies are going up because they are coming in, cash is going down. And then as we look at the accounting equation here, it's on the asset side only. So again, an asset goes down and an asset goes up. Nothing happens over to the equity side, so we still balance out. Okay, then we purchase equipment for cash. So again, it's the same thing. Cash goes down and equipments go up. They are both assets. So when we go over to our equation, we'll see again, they're both on this side of the equation. Nothing is happening over here on our liabilities and our owner equity. So our equation still is in balance. Okay, then we purchase supplies on credit. So now credit means we didn't pay cash, we owe somebody. So now the accounts involved are accounts payable and supplies. So accounts payable is a liability and supplies is the asset, but both of them are going up. We got an asset and then we incurred a liability. So as we look at this accounting equation, we see it is on both sides. So supplies go up and our liabilities go up. And then now our equation goes up by that, but it still balances. Now we provide services for cash. So this is again where it gets a little bit trickier. So the cash comes in, so that's an asset, but then revenue also is earned, and that's equity. So then our cash goes up, which is on our asset side, and then our revenue goes up, which is in our equity side. But again, we still balance. Now we pay expenses in cash. So then our cash goes down, and then our rent expense goes up. But then when expense goes up, it makes equity go down because it's reducing our net income. And then we also paid salaries again. So that goes up and that reduces our equity. So as we come, as we come over to the accounting equation, again, cash is going down for what we paid. Expenses are going up, which reduces our equity. But again, we still stay in balance. Now we provide consulting services and rental revenues on credit. So we've got an accounts receivable. It's on credit. They owe us, so that increases. Our consulting revenue increases and our rent revenue increases. So as we look at our accounting equation for that one, again, our accounts receivable is an asset and it increases, and our revenues, rent and services, increase. So that increases our equity. And again, though, we still balance. Now we collect on that accounts receivable. So cash goes up, accounts receivable goes down because the customer paid us. And then as we come to our did I go past it? Okay. Yeah, so here it is. So cash goes up, accounts receivable goes down, and again, there's not our accounting equation still balances. Okay, then we have our payments of accounts payable. So we didn't pay the full amount, but we pay part of it. So cash goes down because we're paying, and accounts payable goes down because now we no longer owe. We've reduced that liability. So then here we see cash go down, here we see accounts payables go down, and we still balance. Okay, then we pay a dividend. So cash is going to go down, and then dividends paid are going to go up, but dividends are paid out of our equity. So it reduces our equity account. So as we come over to our equation, we see, okay, cash goes down and dividends are paid out of our equity, which reduces our equity, but we remain in balance. So then here's a big summary that shows all of those transactions kind of line by line. And then if you come down to the very balance, though, you still will see that we balance out our assets equal our liabilities plus our equity. And that's always our goal. Now then we have these 4 different financial statements. So we start with our income, which is revenues less expenses, that equals net income. And then we're moving on to our statement of retained earnings. So our net income rolls into the retained earnings. Dividends are paid out of retained earnings, and then that will create an ending balance. That ending balance of retained earnings will then go into the equity section of the balance sheet. But you can see the balance sheet is our accounting equation. It's assets equal liabilities plus equity. Statement of cash flows is a more advanced statement, and we will get to that at the end of the course. So this shows you, though, what I was trying to explain, that these roll, or they go from one statement to another. So you have to start with your net income. Revenues less expenses equals net income. That net income is going to be an addition down here into our statement of retained earnings. Our dividends are paid out of that. to calculate our ending balance, and that ending balance goes down into our balance sheet. And again, the balance sheet is assets is equal to liabilities plus owner's equity. But again, that retained earnings is a piece of that owner's equity. And then again, I'm going to kind of skip over that. We will get into detail on that statement of cash flow at the end of the course.